Welcome back to the Deep Dive. Today we are diving into one of those fascinating contradictions on the market right now. Coal India, ticker Coal India. We've got a stack of sources here, financial reports, technical charts, big picture energy studies, and the picture they paint is, well, it's completely polarized. So our mission today is to really get to grips with this duality. How can a company be facing these huge rising structural risks? The threat of being phased out by clean energy, and at the same time be showing one of the strongest, most bullish stock chart patterns we've seen in a while. We're going to try and synthesize a full year of what you might call fundamental noise with this very sudden, very powerful technical signal. Let's unpack it.
That duality you mentioned, that's everything here. We're looking at a fundamental policy and economic conflict, and it's all playing out in this one share price. Over the last year, the key themes have been, well, pretty volatile production, some really aggressive long-term targets for fiscal 26, and mixed quarterly earnings that have really split the analysts. And then there's the big one. That rising structural risk. It's driven by the undeniable acceleration of renewables.
Okay, so let's start with the raw data, the numbers, because the conflict shows up immediately.
Yeah.
Let's look at December 2025.
Right.
This is the company's ability to produce versus the market's willingness to actually buy.
Yep.
So we saw production, it was up 4.6% year on year, hit 75.7 million tons.
Yeah.
So that tells me they can get the coal out of the ground, no problem there.
So machines are working.
But then you look at the other critical number, offtake, which is just a fancy word for sales, what the market actually bought.
And that number fell. It fell 5.2% in the same period, down to 64.9 million tons.
Production up, sales down.
That's a giant red flag. It points straight to near-term demand softness. They're basically building up a stockpile of unsold coal. But the real story, the one you need to watch, is where that demand is falling.
Okay.
For Coal India, the power sector is their bread and butter. It's always been their main customer.
Historically, something like 85% of their sales, right?
Exactly. But in December 2025, the power sector's share of that offtake dropped to a multi-month low, maybe even a record low, of about 77%.
Wow, so down from about 83% just back in March of 2025.
Yes, and that decline has happened for 4 straight months. It's a trend.
So wait, 77%. That's not just a volume dip, is it? It feels like something bigger.
It's a loss of reliance. It's a structural shift. When the power sector's share drops like that consistently, it means other sources are stepping in.
Renewables.
It has to be. Renewables are meeting the demand that coal used to fulfill. And that makes the company much more vulnerable to pricing in, other smaller industrial segments. They lose their leverage.
And we can actually connect this drop to some broader macro revisions. India's power demand growth estimates for fiscal year 26 were, well, they were slashed.
Slashed is the right word. Analysts cut their forecasts from a pretty optimistic 4 to 4.5% all the way down to a modest 1.5 to 2%.
So what does that tell you? Why the sudden cold feet?
Well, the official line cited things like an extended monsoon, cooler weather, so less need for air conditioning, less power use overall.
Okay, that makes sense.
But the reality is demand is just normalizing at a much lower growth rate than anyone expected. And for a company that's structured for aggressive expansion, that is a huge immediate headwind.
Let's talk about the financials from Q3 because the reports were a mixed bag, is putting it mildly.
The financials were a puzzle, for sure. Some analysts, they focused on the year-on-year numbers. So, comparing Q3 2025 to Q3 2024.
And they had declines.
Right, declines in profit and revenue, and that naturally spooked some investors. But if you zoomed in and looked at the quarter-on-quarter trend, so Q3 versus the last quarter, Q2, the picture was actually stronger.
How much stronger?
Well, for Q3 fiscal 25, profit jumped about 35% quarter-on-quarter. Revenue was up 16.6%.
So compared to last year, it's sluggish, but compared to the last 3 months, it's flying. What does that volatility signal to an investor?
Deep uncertainty. It suggests the company is really reactive to short-term cycles, to weather swings, rather than riding some stable structural growth trend.
And this prompted some of the big banks to react.
Yes, it did. This uncertainty prompted at least one major global broker, JP Morgan, to cut their target price. And their reasoning was simple. Weak power demand and growing oversupply. When you hear the big institutions start using the word oversupply, you know the cautious voices are getting louder.
Okay, so now we have to look forward. Because Coal India isn't just sitting back and watching this happen. They have some massive plans.
Oh, they're running straight at the problem.
An extremely aggressive coal supply target of 900 million tons plus in fiscal year 26. To hit that, they need growth of over 18%.
In just a couple of years, and 74% of that mammoth supply is earmarked for the power sector. It is a huge bet. that India's energy transition is going to slow down, or at least stall, until 2026.
And they're backing that bet with serious money. CapEx.
Very serious capital expenditure. They've planned around 16,000 crore rupees in CapEx. Just to put that number in context for you, that's an absolutely colossal sum. It's like building several major infrastructure projects at once.
And where's that money going?
It's a multi-pronged strategy. They're increasing capacity, they're mechanizing mines to boost efficiency, expanding underground mining, and critically building infrastructure. All of it is designed to lower India's dependence on more expensive coal imports.
And then there's the corporate strategy angle. The Prime Minister's office, the PMO, has directed them to list all of their subsidiaries by FY30.
Yes.
Now, in theory, that could unlock a lot of hidden value for shareholders, but it also adds complications, doesn't it?
Absolutely. It creates what the market calls overhangs, regulatory headaches, uncertainty. Spinning off and listing multiple major units is complex, it's time-consuming, it's prone to delays. So that can really dampen sentiment in the short term, even if the long-term benefit is there on paper.
This is where that ambition really collides with reality. We have to talk about the physical reality of the energy transition. You called it the inflection point.
Yes, the inflection point. There was a study that came out in January 2026, and it revealed something truly historic. For the first time in about half a century, basically since the company was founded, India's coal-fired power generation actually fell year on year in 2025.
No.
Fell. It declined roughly 3%, from 1,322 billion units down to 12,283.
A 50-year relationship is broken? That sounds like a seismic shift, not a weather blip. What does that mean for an investor?
It means the structural impact of renewables is no longer an abstract future risk. It's a measurable present-day reality. That decline was driven, unequivocally, by strong growth in solar and wind.
And the implication?
The implication is profound. The coverage we're seeing suggests India may need to fundamentally revisit its plans for adding more coal capacity out to the 2030 horizon.
Which leads to the scary term for investors.
Stranded asset risk. Exactly. If Coal India spends 16,000 crore today to build up all this capacity, but the government decides in 5 years that those coal plants just can't compete with cheap renewables, then that capital becomes stranded. It's an asset that becomes worthless well before its useful life is over.
So with this, this existential threat on the horizon, why are investors still holding the stock? There must be a counterargument.
And that's the magic question. The company has undeniable strengths. First, massive scale. It controls over 80% of domestic output. It's a behemoth.
And it generates cash.
Huge, healthy free cash flow. And critically for income investors, it maintains very robust dividend payouts.
The dividend.
For anyone focused on consistent income, that scale and that volume visibility, which is essentially guaranteed by the government for the next few years, makes it very attractive, despite all the long-term noise. It functions more like a utility stock. You know, predictable cash, maybe low growth, but a high dividend.
Okay, let's shift gears. We've laid out the deep fundamental anxiety, the demand slump, the long-term risks. If the news flow is basically writing the company's obituary post-2030, why is the stock chart completely ignoring the memo?
Because the market often operates on a much shorter time frame than ESG analysts. The technical pictures suggest that the near-term cash flow story has completely taken over. For most of the past year, the stock was just stuck. It was locked in a long consolidation phase, moving sideways between roughly 360 and 395 rupees, a period of total indecision.
And then?
That indecision ended decisively. We saw a very strong bullish breakout, and it launched the price sharply up into the 430-plus zone.
What's most important about that move?
The volume. You have to look at the volume. We saw strong, wide-range green candles, and they were accompanied by these visible, heavy volume spikes. High participation. That signals institutional money, the big funds, are buying this story. That lends serious credibility to the breakout.
So if you're a learner, maybe you just started following this stock, what's the one key indicator that confirms this strength is more than just a momentary blip?
That would be the golden crossover. We saw the 50-day moving average, which tracks the shorter-term trend, crossed decisively above the 200-day moving average, which is the long-term trend.
So short-term momentum is now pulling the long-term trend up with it.
It's a textbook signal. It confirms a significant shift toward a medium-term uptrend. The consensus, the money flow, has changed its mind.
But this is where it gets compelling for me. Momentum is fast, but it's not infinite. We saw the relative strength index, the RSI 14, push way up into the overbought zone. It was hovering around 70.
And that's the warning label. The RSI measures the speed and a change of price movements. A reading up around 70 confirms incredible short-term strength, but it also means the stock has moved too far, too fast. It hasn't caught its breath.
What usually happens next?
Historically, readings this high often lead to one of two things. Either a time correction, where the price just moves sideways for a while to let the indicators cool off, or a price pullback. For a new investor, buying right at this moment might mean you're buying the temporary peak of this momentum wave.
So we reconcile these two completely different stories by looking at time horizons.
Exactly. For the next 1 to 2 years, Coal India seems positioned as this cash-generating utility-type play. It's got scale, it's got volume visibility, but the growth potential is modest, and its price will be extremely sensitive to power demand cycles and any sudden policy shifts.
So if you, the learner, are watching this stock now, trying to figure out if this breakout has legs, what are the two key drivers you need to be monitoring every day?
Okay, two things. First, the power demand trajectory. The crucial test will be power demand heading into the summer of 2026. Does it bounce back strongly? If it does, those weak December numbers will be forgotten instantly.
And if it stays sluggish?
The stock will feel the pressure very, very quickly. The second driver is policy execution. You have to watch the progress on those subsidiary IPOs. Any delays will hurt sentiment. And how efficiently is that 16,000 crore in capex being spent?
So let's apply this. For an investor looking at the chart today, where is the tactical battleground?
We can map out the risk and reward zones pretty clearly. Immediate resistance is that recent high around the 430 to 435 rupee zone. If the price gets rejected there again, it would signal that a short-term top is in and we should expect a correction.
And if that pullback comes, where's the safety net? Where did that old resistance become new support?
Immediate support is the most critical area to watch. That's a prior consolidation ceiling around the 390 to 400 rupee zone. The rising 50-day moving average is also in that area.
So holding that level is key.
Vital. Holding that level on a pullback would confirm that the stock has structurally moved to a higher price range. Breaking below 390, on the other hand, would suggest the breakout might have failed.
So what's the tactical view today?
Based on the chart right now, fresh entries offer a less favorable risk-reward. The stock is just too extended. I think it's highly advisable to wait for one of two things. Either a dip back toward that strong support area around 390-400 to get a safer entry, or a clear breakout above that 435 resistance on new strong volume. Don't chase the speed.
Okay, so bringing it all home, what does this mean for the longer-term investor beyond the immediate tactical trade?
Beyond the 1 to 3 year window, the news flow is just overwhelmingly pointing to rising structural and ESG risks. The long-term valuation of this company is now extremely sensitive to its ability to diversify and manage its assets beyond those FY26 targets. If they can't execute a pivot, those stranded asset risks will become a reality, no matter how strong the dividend is today.
This has really been a deep dive into an economic paradox. You have powerful short-term technical optimism, confirmed by this decisive volume-backed breakout and a golden crossover.
Right.
And that momentum is being counterbalanced by these persistent, escalating long-term risks driven by the energy transition and that historic 50-year break in coal generation. The institutional money has clearly cast its vote for the next 2 years.
They've voted for the cash flow. But here's the final thought for you to take away and mull over. The stock is overbought. A pause or a correction is inevitable. The question is, when that correction comes, will the floor be set by the stable, cash-generating, dividend-paying utility story in that 390 to 400 zone, or will the specter of the 2030 capacity rethink and stranded asset risk ultimately set a floor far, far lower?
Food for thought indeed. That's all the time we have for this deep dive.